Okay, well, I think we'll get going, everyone. Morena, good morning. Kia ora tātou. My name is Craig Stobo, and I have the pleasure of hosting this webinar on behalf of the CFA Society. Particular welcome to Society members, associate members, and candidates. We've also got INFINS members joining us today, and we have other guests, including the media, and you are most welcome. There is no Chatham House rule today. We welcome your attendance. As you'll appreciate, the CFA Society does value education for all its members. It's an important part of our mission. It's always good to hear global views from a person such as Dhaval, an authority on interest rates and inflation. So a very big warm welcome to you, Dhaval, Joshi. I know it's 8:30 p.m. in London time Monday night, so you already had your day and we're about to start ours, so appreciate you turning up and giving us your thoughts on the topic, the road to inflation ends in deflation. For those of you who don't know, Dhaval is currently BCA Research Chief Strategist. He was previously Chief Strategist for European Investment Strategy, Chief Strategist RAB Capital, Global Strategist Societe Generale, Investment Manager at JP Morgan Fleming, where he specialised, interestingly enough, in applied behavioural finance. Dhaval has an MA from Cambridge University and is affiliate of the Institute of Actuaries. So with that broad opening, establishing your credentials, Dhaval, a warm welcome to you, and let's go through what is basically an unscripted presentation by you with slides. I intend to clarify where I can those slides, and then we'll invite the audience to send up Q&A, and we'll endeavour to go through questions from the audience on your presentation, which I hope is not too gloomy. Let's try and be optimistic about what this all means for us. So over to you, Dhaval, with your slides. Thank you.
Great, thanks very much for the introduction. So hopefully you can see that now. Let's start the slideshow.
Yep.
Beginning. Okay, yeah. So the basic thesis in this presentation is that the road to inflation, if we ever take that road, ends at deflation. So the first step in this argument is this idea which I call the predictability of shocks. Now this sounds quite counterintuitive, and it is actually very counterpoint to the received wisdom. The received wisdom is that you cannot predict shocks. You cannot predict, no one predicted the pandemic. I don't think anyone predicted the global financial crisis. No one predicted Brexit, really. I mean, no one thought it was going to happen. So individual shocks, we fully accept, are unpredictable, the nature and the timing. But here's the thing, if you look at the statistical distribution of shocks in any length of time, so let's take a 10-year period as we're showing in this slide, the statistical distribution is very, very predictable. And so what we've done here is we've looked at the last 50 years of the incidence of shocks, just to see if there's any sort of regularity in the distribution. And remarkably, as you can see here, it is a remarkably predictable distribution. For those of you who are interested in the technicals, it's a Poisson distribution in terms of the number of shocks, and it's an exponential distribution in terms of the time between shocks. But the key point here is that on a 10-year horizon, the probability that you have 0 shocks is negligible at 4%. In other words, there's a 96% chance that we're going to have a shock of some sort in the next 10-year period. And over a 5-year period as well, we can do exactly the same analysis, and it's an 81% chance. So very, very high chance there's going to be a shock. Now, one thing we should clarify is what is our definition of a shock. There is no set definition of what constitutes a shock. So the way we've defined it is any event that causes a long duration bond price, in other words, a 30-year bond price, to move up or down by 25%. So that would be something like the US 30-year Treasury or the UK 30-year, any major economy 30-year bond has to move up by 25% or down 25% as a result of an event, and that event we then define as a shock. So what I'm really saying here is, look, if you're a long-term investor, let's just say even if you've got a 5-year horizon, there is a very, very high probability of a shock, and you have to build it in to your forecast, because if you don't, you're missing out on something that's going to be very, very major in driving the price of assets.
So importantly,
go ahead.
Sorry, Dhaval, just to be clarified, this is importantly in an ex ante sense. So it's something we can rely on for the future. It's not ex post, it's ex ante.
Well, it's ex ante in the sense that we've used the history of the last 50 years, and we've said, is there a consistency in the incidence of shocks? So if we'd used the 40 years up to 10 years ago, would that have been a good predictor of the next 10 years in terms of distribution? And broadly speaking, the answer is yes.
Right.
So I mean, it's whether it's and I said 96%, whether it's 96 or 92 or 97. I'm not sure it's accurate to that degree.
Yeah.
We can say that you need to build a shock in to your forecast if you're a long-term investor. Very, very few do, because most people say, blue sky, the shock comes along, nothing we can do about it. It's just one of those unfortunate things. That's the wrong way to approach this problem. So now let's go to let's be a bit more specific and talk about the shocks that we've experienced. But also, I think the key question we have to ask at this point is, okay, there's going to be a shock, but as far as as an investor is concerned, I need to know, is it going to be inflationary or deflationary, right? Because that will affect how I position for it on a 5-year view. But if it's inflationary, I should do this. If it's deflationary, I should do that, right? So let's address this question: is the shock going to be deflationary or inflationary? Well, the simple answer is that all shocks have both a deflationary and an inflationary component. So what we've done here is we've listed the 7 shocks of the 21st century so far. And what you will see is that in all cases, in most cases, these were deflationary shocks. So you sort of start off with, this sort of big deflationary shock. But then, of course, there's a policy response, which then causes sort of what I call an inflationary backlash. So that's what happened in the dot-com bust. Then you had the GFC, exactly the same, Euro crisis, EM recession, Brexit. And then this is the odd one, because this was what we call the reflation trade shock. So this one actually starts off with inflation, and then you get the deflationary backlash. But I think that, and then of course you have the pandemic as well as the final shock. But what you will see here in every single shock so far, the deflationary component, whether it's first or second, has been larger than the inflationary component. So in most cases, the deflationary shock comes first, and then you get the backlash, but it's not enough to take you to where you started on the yield. Same, as you can see. And here, the reflation trade, took the bond yield up, but then you've got this big sort of backlash from markets, which then caused this sort of deflationary backlash. So what you're seeing is the bond yield obviously is trending lower and lower, because the deflationary component is always larger than the inflationary component. So what we have to ask is, in the next shock, is it going to be the same? So I would say yes. If it's a deflationary shock, very, very likely we're going to see the yield come down. It's not going to get back to where it started. But the question is, what about if it's an inflationary shock? Why would that end up net deflationary this time round? So for this, I think we have to we'll go to the next slide. And for me, the key vulnerability right now is the global real estate market. And these these 2 charts illustrate why. What we've had in the last decade is sort of unprecedented in any time of economic history, where we've seen the value of global real estate double from 150 trillion to 300 trillion in a decade. So that compares with a stock market value of 90 trillion and a global GDP of 90 trillion. So what we're really saying is that the increase in the value of global real estate in the last 10 years is almost twice as large as the global economy. And that is really unprecedented. That's never happened. And if you think about it, what's remarkable is that it's occurred across all sectors of real estate, whether it's agricultural, whether it's commercial, whether it's suburban, whether it's city centers. And what's also remarkable is it's been global. I think no part of the world has been unaffected by this. So we've had it, you've had it, obviously you've seen it in Auckland. We've had it in, San Francisco, Vancouver, Montreal, London, Mumbai, Shanghai, everywhere. Even Germany, Germany is the one place that tends not to have real estate bubbles or booms, but even Germany has seen phenomenal increases in Munich, Berlin, and so on. Now, the other point on the right slide is what has caused this massive increase in real estate prices, and you can see that the bottom two lines are the rents and GDP, but real estate prices have outperformed those significantly. So what we're saying is this bit here is really valuation. So yes, rents are up by whatever 30%, but prices are up by 80 or 90%. So we know that the bulk of the increase has been a valuation story. And that valuation story is really to do with this massive synchronized decline in bond yields that we've had globally. And that's very clear on the next slide, because what we have here is the rental, the dotted line is the rental yield, which, as you can see, has come down quite significantly from over 4% to below 3% in the space of a decade. And the thing that's really driving it down is this downtrend in bond yields. And therefore, what we're saying is there is a limit to how much the black line, which is bond yields, can go up before the elastic gets really taut and start pulling up the rental yield as well. So just empirically, we've said that the maximum deviation in the two lines has been about 100 basis points. And from where we are now, we're already starting above the yield by about 25-30 basis points or so. So just empirically, we can say that there's going to be about, we've got a 75 basis point maximum cushion before you start to see an impact on real estate valuations. What's the mechanism? The mechanism is just affordability, because the marginal price in any transaction is going to be set by affordability. So we have very high prices now, but we have very low mortgage rates, and that's sort of just making affordability sort of tolerable. So you don't need to have a significant move in those mortgage rates to really dramatically impact affordability, and therefore at the margin, that is what's going to set the price. And this is really where we think, that, let's just say we have some sort of inflationary scare, whether it's, it could be a fake scare, a pseudo scare just caused by some very short inflationary data that causes bond yields to move up, as I say, about 50 to 75 basis points from where we are now. Then I think that this could be the sort of the backlash. Certainly in terms of size, this is where this is the sort of the area we should be most concerned of. And I say it is unprecedented that we have had such a big increase in global real estate valuations. As I say, the valuation increase is about equal to global GDP, and that really hasn't happened. And that I think is what makes the situation very, very unusual.
Just to Dhaval, a couple of questions for you. Why include China and US in the same definition for the bond yield?
Right. So the simple answer to that is that China and the US are the two biggest real estate markets by value. So we looked at, I mean, a company called Savills does a really detailed breakdown of, prices and valuations. And China has become either the first or, is a close run thing between the US and China, which is the largest global real estate market now.
Okay.
For that reason, we use those two. But I mean, to be honest, the relationship wouldn't change if you use just the US. It wouldn't be quite as sort of tight, but it's the same sort of story.
Okay. And a clarification of the source of the valuation of global real estate. What was the source of that information?
So that's from Savills Global Research.
Okay.
So and it's all public information. So you could just it's all on the internet. It's all it's all on their website. And they cover global real estate. So I think that at this point, the obvious question that people ask is, well, I thought that real estate gives you a hedge against inflation. So why should we worry about real estate prices if inflation is going up? Because it's a real asset, right? And therefore it should be relatively protected against inflation. So there's a couple of answers to this. I think the first answer is on the next slide, which is that when we think about inflation, everyone's saying we want a little bit of inflation. We aspire to it in a way, because we think that if we get 2%, 3% inflation, that's actually in a way going to sort of wheel the oars a little bit. And in fact, the central banks have actually changing their mandates slightly, saying, well, we're going to sort of tolerate an overshoot above 2% because we think it's actually going to be good for us. The big sort of flaw in this argument is that the central banks and policymakers are assuming that inflation is basically what's known as a linear phenomenon, and it's controllable. So you can sort of fine tune it and say, well, I want to pick 2.5, I want to pick 3, I want to pick 1.5. Let's go for that. In reality, inflation is not a linear phenomenon, it's a non-linear phenomenon. And what happens in a non-linear phenomenon is that you can't sort of fine tune and pick the number you want. You have a choice of phase shifts. You can say, look, you can choose which phase you're in, but you can't actually fine tune where you are. So really what I'm saying is that here's a classic example, and there's loads of examples, but this is Hungary in the 1920s. And you can see on the bottom, we have the money supply, currency in circulation. And here we have the price level. So what we're really saying is, you sort of stimulate, nothing really happens, right? And then bang, you get your inflation. And that's your non-linearity. So you're really going effectively from price stability to price instability. And that is really the danger of trying to get inflation, is that, and the sort of physical analogy I give, and this is quite a good one, you should try this, is get a brick, a really heavy brick, attach an elastic band to the brick, and try and pull it along a table or a rough surface. So what you'll find is you pull the elastic and then nothing happens, because the brick's too heavy to move because you're not pulling it out. And at a certain point, the tension in the elastic overcomes the friction on the table, and suddenly the brick hits you in the face. So, what I'm saying is, look, there's two phases here, or two options. Either the brick isn't moving, in other words, you've got no inflation, you've got price stability, or the brick hits you in the face. In other words, you have uncontrolled inflation. And this happens all the time, by the way. We've got it in Turkey, in Venezuela, Colombia, Zimbabwe. That's really the choice we have. So what happens in this sort of, if you do get that, inflationary shock or that sort of uncontrolled inflation, this impacts valuations of all real assets. And I'm going to give you an example here, a really important example. This is the valuation of equities and the subsequent return you get from that starting valuation. So the black line is the trailing PE, or just it's just a valuation of the stock market in the US, and the green line is the subsequent 10-year real return that you got from that starting valuation. It's a pretty, as you can see in the post 1990s, when we started to get inflation, stability or price stability. It's a very, very tight relationship and a pretty good fit, you can see. So, what we're really saying is to get a real return of around 10%, which you will see on the right scale, you basically needed to start off on a PE of 15. However, in the inflation era, the inflation scale, you can see that to get the same real return subsequently, the same 10% return, the valuation had to halve. So you were at sort of, rather than at 15, you were at 7.5. So a halving of the valuation. Why is this? Because investors see this sort of uncontrolled inflation and they sort of try and front run it and say, well, look, I need a substantial risk premium because I don't, you're letting inflation rip. I have no idea where it's going to be, 5 years time, 10 years time. And therefore my starting valuation needs to be considerably lower to generate that same required return. So what I'm really saying is that the inflation, if it became uncontrolled, that's very, very likely because of the sort of this nonlinear phenomenon that I'm describing. It would mean that the valuation collapse would be much greater than the increase that you're going to get in rents or dividends and so on. So stock, prices do drop. And as I say, the value of real estate is extremely elevated relative to GDP. It's never been this elevated. But it's not just real estate. So real estate would react slowly, right? Because we know that there's no sort of, we don't mark to market on real estate prices on a day-to-day basis. But when it comes to financial assets, we do. They're marked to market on a sort of millisecond basis. And that's a very similar story to what we've just seen in real estate. So here's the next slide. So, what I'm really saying is, look, let's look at what's happened to the global stock market over the last decade or so. And yes, obviously, you can see that the price, which is a sort of brown line, yeah, we've seen a pretty close, we sort of doubled in price from, this is the sort of peak or close to the peak prior to the GFC. But what has caused this increase in price, this doubling of price? Well, this is quite scary because from a global equity perspective, profits haven't really gone up. Profits are only up very, very slightly over the last decade. So this is this is the sort of peak or close to the peak of profits around sort of pre GFC, and we haven't really got significantly above it in the subsequent 10, whatever it's 15 years or so. So by definition, if the price has doubled but the profits have gone nowhere, this is really a valuation story, and that's just arithmetic, right? It's an identity. So just like the real estate market, the bull market in stocks, certainly globally, is a valuation story. And it's a valuation story driven by this massive decline in bond yields. But here we have another added sort of complication. This is a new concept which I want to introduce on the next slide. So what's happened is that obviously as yields fall, and we know that yields have fallen quite dramatically over the last decade, we know that there's two components of the equity return, and one is obviously the risk-free rate, which is basically the bond yield. So as the bond yield drops, obviously the risk-free rate is going to drop on equities, so that you'd expect the required return on equities to drop. But there's this second component, which we know is the risk premium. Now the interesting thing is that the other really unusual thing about the last 10 years is we've seen this new phenomenon whereby the risk premium on equities this is a sort of a theory from behavioral finance, which says actually as bond yields get closer and closer to zero, the risk premium on equities compresses, and therefore the required return on equities declines in an exponential manner, which is what we're showing here, which means obviously the valuation goes up in an exponential manner. Now, why is this? Well, it's this concept known as negative skew. So let me just sort of explain this. What happens is that as bond yields reach their lower bound, clearly the scope for the price of the bond to go up diminishes, because there is no, you can't get any more capital gain because you're already at the lowest yield you could be. However, the price, the scope for prices to fall increases in a sense. So what happens is bonds start to get this property known as negative skew. So you've got a complete asymmetry in your potential return. You have very little upside, but massive downside. And this is also what we see short term with equities, that equities have this very clear negative skew, which is, when markets crash, they crash violently, but they go up more slowly. So the metaphor is, you climb up the stairs, but you fall out the window. That's the kind of profile we have with equities. But what happens is that bonds get exactly the same profile at low yields. And this makes it this is the interesting point, is that the way that the latest theories of behavioral finance say, look, risk is not about volatility, it's about skew. Because volatility is very hedgeable. You can hedge your volatility just by position sizing, but you cannot hedge skew. So suddenly everything becomes clear. The reason that we have a risk premium on equities, normally, this risk premium is normally equities have the negative skew, bonds don't have the negative skew. That's the reason we have a risk premium. That would be the sort of behavioral finance explanation, the sort of Kahneman-Tversky explanation for the risk premium. So it's nothing to do with root mean squared, root mean squared volatility. That's the sort of theory. That's the conventional theory. But the new theory says it's not about root mean squared volatility. It's actually about negative skew. And as we get to lower yields, you can see that the negative skew of bonds increases relative to equities. Therefore, the risk premium diminishes and eventually gets to zero. And that's really what we have seen. So this is the sort of theory, and on the right we have the sort of empirical evidence. So here we have the 10-year bond yield, and here we have the prospective return based on a previous slide. Where we showed the valuation and prospective and the implication for prospective return. We did that for global equities, and this is we're getting sort of the theory and the practice are reasonably close. So what we're saying is the sensitivity of stocks here at low yields to higher bond yields is exponential, especially if you have long duration equities, because they're most sensitive to the rise in yield. And that's why, when we had that little wobble a couple of months ago, as yields were going up, it was long duration stocks, the highly valued long duration stocks that started to wobble. So I think this is really fitting into this theory pretty well. Now, one other, you can say, look, can you sort of demonstrate this exponential relationship? Well, this is one way of demonstrating it. But the next slide is another way of demonstrating it. So here, what we're just showing is the bond yield, and it's on a logarithmic scale. Obviously, it's on an inverted scale, inverted log scale. And then the green line, green dotted line, is just the world equities 12-month forward PE. In other words, the multiple on the market. You can see it's a pretty decent fit when you've got this sort of log versus linear. And the key point I'm trying to make is, look, because of this sort of log versus linear, you can visually see that going from 4 to 3 has, or should I put it this way, going from 3 to 2 has a much bigger impact on the multiple than going from 4 to 3. And we could carry this on, right? So, and you can see it's a pretty decent fit. Now, question is, why have we put US and Italy here? Mm-hmm. Simply because in this period here, this is the Euro debt crisis. So the Italian yield was quite instrumental in driving global equities. But subsequently, from about 2013 on, it's really all about the US, because the US and Italy have kind of basically converged from 2013 onwards. So it's just this period here where Italy is important, but the rest of it is really about the US. So the Italy bit, as I say, you can ignore apart from the first couple of years. So this is really the key story of what's been happening over the last decade or so. We've had this sort of big increase in valuations of equities, and we've had a big increase in the valuation of real estate, all contingent on the bond yield. And obviously that's why I'm saying that the road to inflation ends at deflation, because if you get this big spike in yields from an inflation scare, that would set off this very nasty deflationary backlash. Now, there's another way of looking at it, which is to say, well, if you buy into this and say, actually, there is going to be another shock, it could be in the next 3 years, next 5 years, certainly in the next 10 years. And even if it's, it could be a deflationary shock in the first place, which makes it very easy to say it's going to be a deflationary shock. But if it starts inflationary, I think it's going to end up or turn deflationary. And at that point, I think that's when we're going to get the ultimate low in bond yields, right? Because what in my sort of shock theory of yields, what I'm saying is that every shock just takes you to a lower and lower yield until you can't get any lower. So in the case of Japan, Germany, Euro area, even in the UK, we kind of got to the low point. So, but it's the US and maybe other sort of parts of the world like New Zealand, Australia, and so on, where Canada, where you haven't hit that ultimate low. But of course, the US is critical here. This is the yield that's going to drive everything. And so I'm going to sort of end the slides on a pretty positive note here, because the question is, what happens if this yield does go down to a lower level? Because remember, it's a logarithmic scale. Well, what you'll see that on the next slide, because we just done exactly the same, but we just extended the axes. So this is the previous slide extended, and what we're saying is, look, what happens if the US 30-year gets to where the UK 30-year got to, right, in the crisis? So the UK 30-year, after the pandemic, at the very, very low point, got to about 50 basis points. And the UK is actually very similar to the US, right? It as an economy. It just had one more shock or a couple more shocks. That's why we're lower in yield terms compared to the US. So when the US gets its next shock, whenever it is in the next 5 years, whatever, I think we're going to be here on the US 30-year. And the good news is, that is going to be give a massive boost to equity valuations based on this sort of log lin or exponential relationship. So that tells me, if you buy into this thesis, that what's going to drive the sort of ultimate end of the bull market is the ultimate low in the US long bond yield. And that will mark the point where you say, well, do I really want to be in equities anymore? Probably not, because this story has come to an end. So this is not the structural bull market in equities is intact, but paradoxically, it's not really going to be a profit story. It's going to be a continuation of the valuation story, not in a straight line, but on the assumption we're going to hit a low at the next shock, whenever it is. Final point though is it means that you should be tilting towards long duration equities, which will benefit from the story. So value stocks will not really benefit, but the long duration stocks, which are sort of most exposed to the sort of further compression in yields, those are the ones that are gonna do well. So I think I've spoken for about 30 minutes or so. So I want to sort of be good at that.
Thanks, Dhaval. That's terrific. So elastic bands with bricks on tables, negative skew. The ultimate low still to happen in yields. Can we just go through a few more explanations for our viewers around what types of shocks are there in your mind? The types of shocks.
Sure. So shocks we can categorize into three groups. So category one is sort of natural shocks. So the pandemic obviously is a natural shock. I mean, but a natural shock could, we've had shocks like the pandemic, which weren't as severe, like the sort of Japanese tsunamis, that sort of natural shock that can really have market implications. Category 2 is political shocks. So in that we would put Brexit, obviously, and we would put the reflation trade, because the reflation trade was really based on the sort of the shock victory of Trump in 2016. That triggered the reflation trade. And of course, the third category is economic and financial shocks. So that would be the GFC .com bust and the EM recession of 2015. So those are the three categories, and it could be the next shock could be any one of those categories.
Okay, thank you. So the US April or recent monthly print of inflation at 4% clearly turns your mind to the appropriate risk premium for equities in an uncertain inflation environment. I get that. If you're a policymaker, though, like a central bank, like the Reserve Bank of New Zealand, to Te Matua, the tools are quite crude to sort of manage the brick sliding across the table with your elastic band. So the current tools are forward guidance, our QE or large-scale asset purchase program, funding for lending, and obviously the OCR, the short-term cash rate. When you have a brick on a table with an elastic band and you have this asymmetric inflation pathway, what tools do central banks have to manage this? Because it's not linear, as you said.
So I think that I think central banks really, if you think about what they're doing, what they do is they control the yield curve. Well, they have three functions. They have to provide liquidity to the banking system, to solvent but illiquid banks. That's sort of role number one. Role number two is to provide liquidity to solvent but illiquid sovereigns, and that's normally easy because there's only one central bank for each sovereign. But it was slightly complicated in the euro area. And that was actually the source of the euro crisis in a way, which is they were refusing to provide liquidity to Italy and Spain, even though we know now they were solvent. But anyway, that's role number two. The role of providing liquidity to the sovereign. And then role number three, which is probably the most important, is to set the yield curve, so interest rates along the term structure. And what I would say is once you've got to a kind of Japan situation or a sort of close to euro area situation where interest rates are pretty in nominal terms are as far as they can go at the short end and pretty close to where they can go down at the long end, then you have to sort of put your hands up and just say, look, we're kind of run out of tools. That's the reality, and we know that's the reality because when we look at Japan's sort of monthly policy meeting, monetary policy, it's like a non-event now. It's the same with the ECB. It's like, what more can you do? So once it's a kind of admission that they've run out. They're close to running out of ammunition on the pure monetary policy front. On the fiscal front, of course, there's loads more ammunition, but that's where the danger is. In terms of you pull the elastic band too far and the brick hits you in the face. That has to involve fiscal policy, by the way.
Yeah. Okay. So turning our minds then to some of the audience who are investors, portfolio managers, it seems to me that the market's kind of aware of the duration risk of bond yields at these low levels, with increasingly lower coupons now on bonds that have been printed, recently issued. And possibly the market's kind of got a cash and equities sort of barbell mentality about it. But I want to explore a little bit more your concept of, duration stocks and call them growth stocks that came off their recent highs as inflation and risk premia changed investor mindsets. But on this pathway through an inflation shock or a shock of some kind that eventually ends up with lower yields, what's the structure of a portfolio look like to you to sort of, let's call it, hedge that environment?
So, well, yeah, I mean, I think in what there's something else I sort of refer to, which I call the Pareto principle of investment. And the Pareto principle is, you may have heard of it as the 80-20 principle, which is that 20% of causes are responsible for 80% of effects. But it's not always 20-80, it could be like 10-90 or whatever. So what we're really saying is that if you get the bond yield right, you're going to get a lot of things right. You're going to get value versus growth right, because they sort of move almost identically. And if you get value versus growth right, you get a lot of your regional allocation right as well, because you sort of value markets like Euro stocks is a value market, S&P is a growth market. So they just Europe versus US tracks value versus growth tracks bond yields, and so does tech. So they're all basically one trade. So what you have to really, to answer your question, you have to sort of say, what's the path of yields? Yields will go up. When yields go up, you're going to get really hurt in growth. You're going to be in value, and that has repercussions for your regional allocation and so on. But then when you get the sort of point of resistance, and then you get the reversal, then it'll turn around. So if you're just thinking about the end point and you say, I don't really care about the journey, it's clear that you want to be in growth until you get to this ultimate low, if you buy that thesis. But obviously on the journey, you're going to be there's going to be a pain, it's going to hurt as yields are sort of rising. But the other point I'd make though is that the second reason why I think those growth stocks will do well in the long run is it's not just about duration, it's because they tend to also be more defensive. Tech, healthcare, generally they can sort of ride out downturns, shocks. Unless it's a very if it's a shock specific to tech, which is that we are a sort of a policy that goes against tech, a sort of breakup of tech. Obviously that would be a sort of very specific shock. But other than that, tech would actually be relatively defensive, as we saw during the pandemic. The earnings remain pretty resilient. So
okay. So in your ultimate low in yields, are you contemplating negative rates in that scenario?
Yeah, I mean, you get negative rates too. I mean, I'm saying my thesis is the ultimate low is -1 or thereabouts. That's the limit before, and that's what policymakers have said, that they see that anything below -1 becomes very, very damaging to the banking system. Unless they force us all to use digital cash. Then everything, then we'd have to sort of reconsider. And that may be one sort of ulterior motive to go down the digital cash route, because then they can just say, look, once you have digital cash, there's that lower bound is sort of up for debate. Yep. But I'm assuming we're roughly in the same sort of world, and -1 is the limit, and we got quite close to that in certain places like Switzerland, and Scandinavia recently.
Yeah, just exploring the 75 basis points kind of trigger for a valuation correction. That amount of valuation uplift due to low yields, that's a big gap that can come off. So while the journey in equities might be fine, as you described, in the short term with that shock, there's going to be some serious changes to valuations in property, as you mentioned. So how does that play out in your mind?
I mean, it could be less than 75 basis points. I mean, I thought, when we saw this sort of the backup in yields earlier this year, we haven't really come down significantly, but we got up to about, I don't know, 175 on the US 10-year. We saw signs that already was having a sort of an impact on the real estate market, because if you look at, for example, mortgage applications for purchase, not for refinancing, for purchase, they moved in response to that rise in yields. So what we're seeing is house price, around the world, pretty much everywhere, homes are expensive. They're already, we're already at sort of stretch levels of affordability, and then add on that, higher mortgage rates, and that affordability it just gets sort of to the point where it's out of reach of a lot of people, and that's where you start to get, obviously there's been sort of, it's okay for the time being because the pandemic has forced people to sort of reconsider where they're living. There's been sort of bidding wars and so on, but this is exactly the sort of environment where prices are sort of very high and accelerating, where you do see corrections or the end of housing booms. Is the sort of scenario you want to, housing booms don't end when things are looking poor. You start off from a sort of a period of ebullience, a situation of ebullience, which is where we're in right now. And I'm just saying that the increase in yield before you see a pinch point may not be that far.
Yeah, that's coming through strongly. So is there an argument for being in non-correlated assets, commodities, gold, insurance-linked securities, other sources of stability, call it, rather than the fixed income and equities asset classes? Is there a diversification story here?
Well, I mean, I think there's certainly at a global equity level, there will be the sort of the bond equity hedge will still work during the crisis, if you pick the right bond. If you pick a bond where the yield can fall. So we saw that in the pandemic briefly, because luckily it was only a short-lived setback. But yes, the 30-year bond in the US was a great hedge against the falling stock market during that sort of intense period of last March 2020 or so, where stocks fell very, very sharply. What was your hedge during that big collapse? The US 30-year worked really, really well. I think if you had them as whatever 60-40, you would have ridden it out extremely well. So the hedge, as I said, the hedge of bonds will only work, where there's a scope for the yield to fall. So the German 30-year wouldn't work as well. The Japanese 30-year wouldn't work as well, because obviously there is, it's a negative skew argument again. The upside is quite limited.
Okay, sort of running out of questions at this end. Dhaval, do you have any sort of comments on kind of social implications of lower yields, which affects obviously savings, and higher valuations in real estate, which obviously affects affordability for people that want to enter into the housing market, which is a huge political issue globally? So it doesn't sound from your thesis that gets any better.
Well, I mean, I think that, yeah, because I think that we've sort of got into this sort of trap whereby each crisis forces us to lower yields. The lower yields push up valuations, and we're going to, the only point, the thing that ends that is when you can't keep doing it. So yeah, so for the time being, that's going to be it's going to be a social problem, in the sense that the people who actually sometimes your financial wealth depends on the fortune of your year of birth. It's well, sometimes, and it's just life in general, that if you're sort of born in certain years, things sort of pan out really nicely for you. 10 years later, everything goes wrong for you. You sort of, if you were born in sort of 1900, you might have lucked out because you missed going in, you missed fighting in the First World War. 10 years earlier, it would have been extremely unlucky because you'd have fought in the First World War, and if you'd survived that, you'd have been hit extremely badly by the Great Depression, just as you sort of came out of that and tried to form a career. So what I'm really saying is that the people who've done well in real estate have mostly done well because of their age. People have missed out because of their age. And one way of obviously easing that is through sort of family transfers. So, and we're seeing that anyway. We're seeing that, if parents are well off, they're supporting their children for longer, either financially or giving them, actually putting them up in their home. So that's one way of addressing it. It's through sort of non-economic, sort of official economic channels. It's through sort of more familial channels, let's say. And then the other issue, of course, is what this, in terms of tax rates. And I think that one of the things to bear in mind, which enhances my story, is that I think that corporate taxes are going to go up over the next 5 years, maybe longer, starting off from quite a low base, because this is a sort of politically expedient way of trying to keep these very large government deficits in check. You're not going to lose votes by, the average person isn't going to protest if you say we're putting corporation tax up. But of course, what that does mean, coming back to, my slide here, is that, we've had a very long period where profits globally haven't gone up. And this was a period where corporate taxes were actually coming down or staying low. So now we're going to have an extra headwind at a global level, which is corporate taxes are going to be trending higher, even if other parts that drive profits, like sales growth, might sort of pick up in the next few years. But against that, corporate, and you could say wages may remain depressed, or maybe they will go up, and that's going to be an added problem to the profit story. So you may say, why has profits gone? This looks really bad. Profits have gone nowhere for 10 years. And it's because in the previous 20 or 30 years they were flying. So this is a sort of catch up, or a catch down, should I say? If we take this back to the 1980 or so, there's a very long period where profits were performing very, very strongly relative to GDP and sales. So there could be a long period where there's a consolidation in profits, certainly at a global level. But of course, if you look at individual markets, like say the US has done well because it's got all the growth stocks and the sort of the tech leaders, where they have done well. But at a global level, that doesn't apply. So profits, as you can say, that this is very strong evidence. Very clear to see very little growth at a global level over the last 15 years.
Okay, well, I'm going to call this a wrap for our viewers, Dhaval. I just want to thank you for taking us through a reality check that there will always be shocks, and the probability of shocks is relatively assured. Timing and size and source is not clear, but we can be assured there will be shocks. Secondly, introducing the concept of negative skew to this audience at very low bond yields, and the impact of that on valuations with a very strongly overvalued or high valued real estate markets around the world, and that policymakers and investors need to be aware of the non-linearity nature of inflation tracks, that we could be reaching the end of a rubber band stretch with a brick on the table, and that will result in changes to risk premiums very quickly, and that will hurt valuations in the short term for duration assets. But your thesis is that over time, that will mean devaluation shocks dominate, and we get to a lower bond yields, and conceivably through to negative rates again. Look, thank you very much, Dhaval. It's terrific. I found it really informative to give us all a reality check around markets and what policymakers have at their tools at disposal, and the importance possibly going forward, more importance going forward of fiscal policy and the changes that you envisage. So look, on behalf of all of us, the CFA Society and our viewers today, thank you so much for presenting at 8:30 p.m. London time. I really do want to thank you. So all the very best to you. Thank you.
My pleasure, and thanks for having me on this.
Okay, kia ora. Thank you very much, everyone. Thanks for joining us. Thanks, Kylie.
Bye-bye.